Welcome back to Morning Trade Live. Let's talk macro and markets ahead of the opening bell. Joining us now is Jim Bianco, president at Bianco Research. Jim, thanks so much for joining the show.
Thanks for having me.
All right, so I want to kick things off by talking about the Fed. We teased it going into the break. You do not think the Fed should cut rates anymore. Tell us why.
Yeah, bearing in mind that there is should and will, I don't think that they should be cutting rates anymore. I don't see any evidence that the economy is having problems. I don't see any evidence that the labor market is having problems, that a Fed rate cut would help. And I don't see any evidence that inflation is, at least for now, continuing lower. What I do see evidence of is the Fed started cutting rates in September, and long-term interest rates went up 90 basis points at their peak. They're up 70 basis points right now. That is the biggest rise that we have seen long-term interest rates do when the Fed started cutting rates in at least 40 years and maybe longer. What does that tell me? The market's rejecting it. It's basically saying to Jay Powell, we don't need this. You're potentially overstimulating this economy. You're potentially adding more inflation. So you keep cutting rates, telling us you're going to help everybody. We're just going to make mortgages more expensive. And that's not getting at what the Fed needs. Now, Powell was asked this question, what does long-term rates rise mean? And he said, well, it can mean a lot of different things. I don't know. Chicago Fed President Austin Goolsbee was asked the same question a couple of weeks ago, and he was a little more blunt. The Fed has to figure it out, was what his answer is. I think they know what the answer is. They just don't like it.
But there has been speculation that that tick higher in the 10-year yield could also be related to, potential tariffs next year that could be inflationary as well. But you think that it's more so the bond market signaling that this was a policy mistake?
Well, yeah, it started. The 10-year yield bottomed the day before the Fed cut rates. So the chart lines up with it. And yes, if it is a belief that there will be tariffs to the extent that we will get more inflation, that's all the more reason not to be cutting rates. You don't cut rates into higher inflation. You just create stimulus to pay those higher prices. If there's going to be tariffs and everybody can get easier money to pay those higher prices, the 50% of the economy that doesn't own assets, that has to rent, is stuck with those higher prices. That's a very bad policy if you're cutting rates because of tariffs.
Okay, so there's the economic implications of cutting rates when you think that the Fed shouldn't be. But I'm curious about the stock market implications, because this is a market that has been rallying in part because the Fed is cutting rates. So if that's a mistake, what happens next in terms of where this market goes?
Well, I'll say that is a common narrative, that the market is rallying because the Fed is cutting rates. July of 2023, the Fed stopped raising rates. Until the first rate cut in September, it went up 23% without a rate cut. And then most of the rally since September has occurred after Donald Trump was elected president, and we had the red wave on the idea that we were going to see deregulation, tax cuts, and a lot of stimulus. I think most of the rally could be attributed to, look, we just have a strong economy. We have companies that are creating earnings, and we have a president that's going to bring in more stimulus. That's why I think the stock market's rallying. And if I was at the Fed, I would say, look at what it's doing for those reasons. It doesn't need cheaper money. It being the stock market doesn't need cheaper money. If you take it away from it, all right, yeah, a lot of algos and short-term traders won't like it, but they'll get over it over time. And it won't have any permanent damage, I don't think, to this economy, because this economy is not permanently damaged.
So if Chair Powell sounds any more hawkish when he speaks later this week, you don't think that that could potentially disrupt the market's run?
Sure, it would. It will disrupt the market's run over the next couple of weeks. And Donald Trump will say mean things about him. And like I said, it will eventually, the correction will run its case. Look, the market by a lot of metrics in the last month is overbought because it's had a giant rally since Election Day. But I don't think that if he talks more hawkish, that it's going to be anything more than just trader noise. It's not going to mark some kind of major top in the market. And I think that he probably will talk a little bit cautious, and it'll all come down to the payroll report on Friday, and it'll come down to the CPI report next week. If those numbers are strong, there's a possibility we might not see a rate cut in December. And I think if we don't get the rate cut in December, I think they're going to have a very hard time finding a reason to restart in January or in March, the next two meetings after that.
Okay, so ultimately, when you think about where this market goes from here, given the fact that the S&P has already run some 26.5% year to date and ran 26% last year, when you think about next year, where does this market go?
Well, I think it probably goes higher, but there's going to be a counterbalance to it. I think you're right. The market's up 26%, 2 years in a row. Crypto's up over 100%. Gold is up 30%. The first time ever that gold and the stock market are going to be up more than 25% a year, unless something big happens this month. And what's happened now is investors' expectations have changed. They think everything should return them 20%. And you see that, if you're online, maybe I'm online a little bit too much, but they think everything should be going up that much. The strategists have big expectations for the stock market. And if all that happens, and I'm not saying it won't, the counterbalance to that will be higher interest rates. Is that no one will want bonds. No one will want to own bonds. I get that. Well, then the price will go down and yields will go higher and higher and higher. And there's an old adage that, yields keep going up until something breaks. And if 420, 440, 460 is not a level that breaks the market, those yields will keep going higher until we find that counterbalance to a rallying market. And if the Fed wants to cut rates into that, then those yields will go up higher faster. And I think we'll find that level that breaks. So that will be the counterbalance we'll have to deal with in 2025 if we get that strong growth in higher, let's call it risk markets, is you will have the offset being higher interest rates. And interest rates have a history of, we could say they don't matter, but they can make themselves matter in a big way. Now, they probably don't at 420 or 430, but there's some level where they will.
Okay, so how big of a headwind will rising yields be for equities, and what areas of the market could withstand, higher interest rates?
Well, I think that, they could become a substantial one. It's a question of where, because like I said, as rates go up and people say to me, see, these rates don't matter, well, then they'll just keep going until they do. And, whether that takes 475, 5.5 on the 10-year or whatever level. Remember, we did get the 475 this year on the 10-year yield. We got the 5% last year on the 10-year yield. So a 5% yield would not be out of line because we've already been at that level. Who would probably withstand that the best if the offset to a rising market next year is higher yields? Probably the companies that are the most delevered, the companies that have borrowed the least debt, that have the lowest interest coverage ratios, that they're not dependent on the bond market for their financing as much. Now, a lot of those companies happen to be tech companies and a lot Mag 7 companies, but be careful there because you have to look to the next level. How about the people that are buying all the chips from NVIDIA? Are they borrowing money to buy those chips from NVIDIA? And then that could then, upstream to those companies as well, too. So it really is going to be, who is delevered, I think is probably going to be best positioned if we're going to go into a higher rate period in 2025.
Okay, so bringing it back to the economy, you yourself said there's a difference between what the Fed should do and what they will do. So if they, as they widely are expected to cut interest rates again in December, what are the economic implications? Because to me, what I'm hearing is the economy is strong enough, we don't need interest rate cuts. So if this is, in fact, a policy mistake, what does that mean for the economy?
Inflation is what it really means. It means that the Fed is stimulating, prices are still rising at around, 2.8% to 3% if you're using core, and I'm using the PCE measures here. And if you stimulate the economy by attempting to make money cheaper or stimulate the economy by pushing the stock market even higher, you're going to make the top half of the country, which is 85% of spending, the top half of the income, 85% of spending comes from them, comfortable with paying higher prices. The bottom half of the country that doesn't own stocks, doesn't own a home, they're just going to have to pay higher prices. That's what inflation does. And we saw the results of that in the election last month, as far as how difficult and how pernicious inflation can be. So if the Fed continues to cut into this strong economy, they risk reigniting another round of inflation. Markets won't wait for that another round. They will anticipate it. And I think that that's what the 10-year yield has been doing since September with all of these rate cuts, is that it is anticipating that the Fed is going to give us too much stimulus. That stimulus is going to result in more inflation. And we're going to demand a higher premium to own bonds. I don't want to own bonds if there's going to be inflation. They will sell off and interest rates will go up.
Okay, so Jim, if the Fed is potentially exacerbating the inflation problem on top of some of these tariffs that President-elect Trump has threatened, 25%, 100%, depending on the country, should we be prepared for the Fed to have to hike rates next year?
You know, it's always possible that the Fed might have to hike rates next year if that's the case. Now, that's going to be very politically difficult because Jay Powell's going to be Donald Trump's punching bag all next year. And he cut rates before the election. I might add, for the first time ever, he started a rate cut, 7 weeks before an election. No Fed has ever started a rate cut cycle that close. And then if he wants to swing around and raise rates, even if it's economically justified, he's going to be skewered alive on social media by the president. So that might impact their thinking. But let me back up a quick second. There's this perception that higher rates are bad and lower rates are good. And that's not always the case. Sometimes higher rates are good. The interest rates should reflect the nominal growth of a country. The real growth, the inflation, add them together. That's where interest rates should be. If we are a strong growing economy with higher inflation or inflation ticking up, our interest rates should be higher. If they're not, they're at the wrong level and they will create malinvestment in our economy. That may not necessarily be a bad thing, but it's hard to make that argument because everybody just thinks zero is the best interest rate, and the higher you get off of zero, the worse it is. And that's simply never been the case when it comes to interest rates.
All right, we have to leave it there, but really interesting insights. Jim Bianco, president of Bianco Research. Thanks so much.
Thank you.
Coming up.